The concept of universal defaults is important to understand because your clients are going to be confused about it. Universal default says that if you are currently behind in some other loan, either a mortgage or a credit card, you're in default everywhere. So a credit card company has the right to increase their interest rate, or loan companies can call in their loan if you are delinquent somewhere else. And this is very confusing to people because they might have a credit card that they're making payments on a timely basis, but they're behind on their mortgage or they're behind on some other loan, and the credit card company will use that to increase the interest rate or call the loan, or in many cases decrease the credit limit. Um, in 2007, credit card companies collected in excess of $200 billion in interest and over $125 billion in fees. And these fees were collected because people were delinquent on their payment. They may have missed it by a week or 2 weeks, or they went over their allotted limit. So it's a gray area whether the credit card companies actually want you to fall behind, want you to miss a payment, want you to go over your limit, because this is an incredible source of revenue for them. And because people are beginning to fall behind right now, the default rate on credit cards are above 12%. Interest rates, more than anything else, is what keeps most people from ever being able to repay their loans in full. The interest rates and the compounding aspects of it, with many of the loans that people have, create an ongoing state of indebtedness for people, and they're never able to come out of it. And this is something that must be explained and must be understood. And that's why I ask you to use the Excel spreadsheets that you'll be able to find on the training page to be able to input all the information in, so you can show your client the calculated amounts as to how much interest they'll actually be paying, what the interest that they are currently paying. And most people are often confused about what their interest rate is on the various cards that they have. The statement comes, they pay the bills, but they don't fully understand or realize or take the time to calculate what the actual cost of that interest happens to be. Through the strategies that we use with debt settlement, in most cases we're going to be able to settle the unsecured accounts up to 80% of its value. So for example, a client might have a $10,000 charge card. In most cases we'll be able to settle that anywhere between 40 to 80%. So they might end up paying $2,000-$3,000 to settle that account, which allows them obviously to be able to pay less but to avoid bankruptcy. And in many cases a payment option is generally available. It's not guaranteed, but there are options to be able to make payments. But in most cases we will have enough money saved up in the trust account, which we'll talk about in a moment, to pay off the settled debt. You're going to find a number of people, particularly small business owners, that have high credit limits and credit balances on their credit cards, particularly local small business owners who have lines of credit with their bank, or American Express business cards or other types of gold cards with high limits. In most cases, you'll be looking at a client that has credit in excess of $100,000 that needs to be settled. So small business owners are going to be a significant part of your business. Look at this example with a client that we had who was recently a small business owner that had many cards, but the American Express card that he had a balance of $41,000. We were able to settle that for $12,000. Can you imagine the excitement for this person to be able to settle this debt for such a small amount of money? Here's another example. A Bank of America Visa card, $16,000 balance. Through the course of the negotiations, we were able to settle this for only $4,000. Let's look at one more. Here's an example of a department store credit card. A balance of $5,000, quickly settled for $1,750. Once you enroll a client into the program, the first steps are of course going to be to analyze and evaluate their circumstances to determine what their appropriate budget is, how much they can reasonably contribute to the settlement of their debts. And it's good to use the tools that are available for you on the website, the Excel spreadsheets and so forth, that will help you calculate what their budget is, how much they can afford to pay, and what's reasonable for them given their lifestyle. and the client will then sign the service agreement and will begin the process of negotiating their debts. And we'll talk more about the service agreement in a subsequent training. But the first step after all of this will be to open the trust account. A trust account is opened with a neutral escrow company, and the funds in the trust account at all times belong to the client. It remains the client's money throughout, and the trust account is important to have because this is where monies will be gathered that we're going to use to settle the accounts. And your client might say to you, well, gee, let me just hold on to the money and I'll just write a check when the debt is settled. That's never likely to happen. Most people will spend the money because there's always a reason to spend the money. The trust account is important to be able to force the client to be able to accumulate the money that's necessary to settle the debts. You don't want to spend the time to be able to settle the debt and then find that there isn't any money to settle the debt. And while the client is, of course, funding their trust account, they're not making payments to the credit card companies. Let's look closely at the budgeting and trust account process. Let's say you have a client whose current obligations are $1,500 a month total combined payments to all their all their credit cards. And what is affordable based on the calculations would be $700 a month. That might be a more appropriate amount of money for them to pay towards their credit cards as opposed to the higher $1,500. So again, in our example, the client begins to fund the trust account by, in this example, $700 a month as opposed to paying $1,500 to their credit card companies, combined monthly debt. And while the client is funding the trust account, they're of course not making payments to the credit card company. So in this case, the client is saving a substantial amount of money every month. These funds in the trust account at all times belong to the client. The client can withdraw this fund at any time that they want to. It's their money. But it is here to be able to allow them to continue the saving process and to be able to have the money available as debts are settled. And debts are going to be settled one at a time. So a client might have 6 or 7 credit cards. Each account will be settled one at a time. And it'll be timed with the settlement as to the time that enough funds are available to settle that account. So for example, the client has accumulated $2,000 in the account. We're able to settle an account for $1,900. Funds are immediately dispatched to settle that account. And then we move on to the next one. So it takes a certain period of time for funds to accumulate, and it takes a certain period of time for the negotiations to have run their course. Clients will often ask, of course, is why can't they just hold their own money and then write the check at the appropriate time? That's never likely to happen. It's a good idea in theory, but in practice it never quite works out because people spend money. There's always a need to spend money. So the forced savings element of having a trust account is critically important to the success of this program. While the client is, of course, funding the trust account, they're not making any payments to the credit card companies. And through this process, we will have filed appropriate paperwork, which we'll talk about later in detail, that your client will be able to sign and will send into the credit card companies that stop the credit calls from coming. So the credit card companies and the collection agencies will no longer be calling the client. And this alone, for a lot of people, is an enormous amount of instant relief to be able to stop those collection calls. Those calls will be directed towards our negotiators at our office. And should a call sneak through, and it may take a while for it to get to all of the various collectors in the departments, should a call sneak through, your client is perfectly within their right to be able to say, look, I'm working with the National Real Estate Council, please contact them, this conversation's over. And that gives a lot of people an enormous amount of relief, as you will quickly see, because most people are afraid to pick up the telephone if they've fallen behind in their mortgage or a credit card accounts. This concludes part 2 of the 2-part basics for debt settlements. Please take additional time to review the rest of the web page and become familiar with the documents that appear there. If you have any additional questions, please email me at info@nrecweb.org, and I look forward to continue the training program with you.